Welcome back to the Fire Grind. My name is Daniel, and in today's video, we're going to be going over the 15 growth stocks that I have in my Wealthsimple Trade portfolio. So currently my portfolio has actually bounced back quite a bit. It's at around $17,000 to date, and I'm only down around maybe 2 to 3% from where I originally started. So clearly the market has recovered quite a bit. So for the growth stocks that I'm going to talk about today, these are the three things that I'm going to cover for each company that I talk about. I'm going to talk about what the business does, the cost basis for my shares, the number of shares I have, and as well as what's the current price, and whether I'm buying more and at what price I'm looking to buy more if I do want to buy more. There's also going to be two stocks that I'm selling off, so I won't cover those ones in depth, but I'll let you know which ones I'm going to sell off. And in addition to that, I'll be adding $200 into my portfolio right now. Because when I started this series, I did mention one of my goals for this portfolio is to continuously add $200 into the portfolio every single month. And this will help me to dollar cost average into the positions that I have. And before we jump into my portfolio, if you're looking to invest with Wealthsimple Trade, you can go down below and click in the link and you'll receive $10 for free once you trade $100 worth of stocks on Wealthsimple Trade. And as well, if you think the market's overvalued and you're looking for a high interest savings account, I also have another link down below for EQ Bank, which is currently offering 2% interest on any sort of a balance that you have in their account. And you'll get $20 for depositing $100 into this bank account. So that's basically a 20% gain right off the bat for only signing up. Without further ado, let's jump into the portfolio. And when we go into the portfolio, you can see my exact amount that I currently have in there is $17,180.04. And over the past day, my portfolio is up 1.81%. And I'm actually releasing another video shortly after this on why the stock market popped on Friday. If you're looking for that answer, subscribe to my channel and hit that notification bell to be informed when I release that video. So the first stock that we're going to talk about in my portfolio is actually WELL Health Technologies. And I actually recently did a video on WELL Health Technologies, and if you're interested in that, I'll link that in the description below. I do a deep dive on the company and talk about all the reasons why I'm bullish on it and what you should look out for if you're going to invest in this. So essentially the risks behind the business. And currently, WELL Health Technologies, their stock price is $2.76. If you go back 3 months, it's actually popped quite a bit, from $1.36 or $1.30 all the way up to $3.27. And my cost basis for WELL Health Technologies is $2.74, and I currently own 60 shares. So what WELL Health Technologies does is that they are a SaaS provider of digital health platforms, as well as they run their own medical clinics. And the amazing thing about this company is that in 3 years, they actually became the third largest EMR or electronic medical record software system in Canada. And they also have become the fourth largest medical clinic owner in Canada. And they are actually the largest medical clinic owner in BC. So they've done this all within the span of 3 years. This is an amazing feat for a company like this. And this also shows another thing about the Canadian healthcare industry. It's that it's highly fragmented. And WELL Health is positioned to consolidate this whole industry. And I think they could be one of the top players going forward as they acquire more medical clinics, as well as expand their EMR software offerings to become maybe even the second or first largest company within Canada. And they're doing this all by acquisition. So check out that WELL Health Technologies video if you're interested in this company. For me personally, currently at 60 shares, I'm looking to increase that to about 200 to 400 shares. And the price point that I'm looking to buy in at is I'll add another 10 shares in the short term if it drops to 260. And if it goes below $2 somehow in the next couple of months, I'm going to be loading up the truck. The next stock that we have on the list is Aritzia. So a lot of you guys probably know what Aritzia does. They're actually a women's fashion company. They have a lot of stores in major malls across Canada. And what's amazing about this company and why I bought into it is because management really knows what they're doing and they know their customers. In all the years that they have been open, they've never actually closed a single store. Unlike other retailers like Gap and Old Navy or even American Eagle, they've had stores closed down on them because they're not able to sustain the sales to keep those stores open. But Aritzia, having such an amazing track record of keeping their stores open, shows me that management really knows what they're doing and they're very careful in the execution of their plan. The company also offers extremely high quality clothing at a reasonable price, and they're doing a US expansion currently, although that's been stifled a little bit by the whole pandemic. Once the pandemic's over, I think the US growth is really going to push this company to new heights. So my cost basis for the stock is $16.16, and I own 75 shares. And currently the price is at $21. The stock price dropped as low as $12 when the whole pandemic hit, and unfortunately I didn't have any cash to buy in then. In my plan going forward for this company and what I'm going to do with my shares is that I'm going to hold these shares, and if the stock price drops below my cost basis because of maybe that second wave of virus, I'm going to be buying more of these shares. The next stock on the list we have is Canada Goose. And if we scroll down here, we can see that currently the price of Canada Goose is $34.10. My cost basis for this stock is $43.32, and I own 50 shares. So yes, I bought it when it was quite high compared to the current price. However, Canada Goose has been battered down quite severely over the past couple of months, and they haven't recovered as quickly as other stocks. But I'm quite bullish on Canada Goose for the long run, because although they're in the luxury parka business, they have a huge opportunity in China. And the reason why the stock hasn't popped based off of the China expansion is because in China there's been a lot of headwinds for many businesses there. In 2019, we had the whole protests within Hong Kong as well as the trade wars happening, which stifled China's growth significantly. And this also brought a lot of risk to investors, and investors sold off Canada Goose for that reason. And also in 2020, the whole pandemic has shut down all retail stores, which caused Canada Goose to further tumble down even more. But after this whole storm blows over and both these situations are diffused, I think Canada Goose is poised for some massive growth. And investors had this bullish sentiment in 2017 when the stock popped up to around $90 per share Canadian. I have also put a video on Canada Goose, and I'll link that down in the description below if you're interested in exploring this company further. I will be continuing to average into this position over the next couple of months, as long as the stock price doesn't shoot above my cost basis. I think right now is a fairly attractive price, and Canada Goose recently reported earnings. And the stock popped because of earnings. Essentially, they didn't lose as much money as analysts thought, and therefore the stock rose. The next stock on the list is Absolute Software, and this company is a bit of a smaller company within Canada. Its current market cap is $550 million. And what Absolute Software does is they provide endpoint security. So what Absolute Software provides to other companies is essentially just software that goes on devices like laptops, such that if these laptops are lost, companies can recover data from them, as well as protect it from any sort of hacker or third-party person that's trying to break into it. And the reason why the stock shot up over the past couple of months throughout this pandemic is because a lot of employees are working from home, and therefore they either need new laptops because they currently have desktops, or they just are bringing their laptops home, and there's a higher risk for these laptops to get stolen. And companies will be going to Absolute Software to purchase their software in order to protect their data from any sort of theft. So if we look at my cost basis for the stock, I actually averaged in around $7.81, and currently the company's share price is $12.86, and I have 50 shares of this company. And what I'll be doing with the stock going forward is that I'll be holding this position. I don't plan on currently buying any more shares because the stock has had a fairly nice run up, and I think there's more risk than reward if I were to put money into it right now. If it pulls back to around the $10 level, I think I'll be averaging in a bit, but right now at $12.86, it's a little pricey for me. And one other thing to note about this stock is that they actually pay a dividend, even though they're a small cap company. They pay a 2.47% dividend. So in the meantime, while I hold, I'll also be paid this dividend. The next stock that we're going to look at is Blackberry. And a lot of you probably know Blackberry for their phones. If you're old enough to own a phone around the 2005 to 2007 era, you'll instantly recognize these iconic smartphones. Blackberry was one of the pioneers of the smartphone. When they came out with their devices, companies flocked to Blackberry for cell phones, not just for the functionality of a smartphone, but also because of their security software behind it. Blackberry has one of the best reputations for their software security, and this has been shown by the number of cars that they deploy their software into. Currently, 150 million cars across the world have Blackberry QNX software in them. These cars employ Blackberry software in order to prevent hackers from hacking into the infotainment system or other assistance software for driving, such as blind spot detection or lane detection. I think this company has a great tailwind for them, especially with the whole autonomous vehicle movement. As autonomous vehicles become more regular on the road, Blackberry software is going to become more and more important, as if a hacker gets into an autonomous vehicle, they can essentially control that car and maybe other adjacent cars or a whole city full of cars. And imagine what a hacker could do. And this could be maybe a way of cyber warfare in the future, where countries will hack into each other's infrastructure and take over cars. So security is going to be utmost important going forward from here, especially with the autonomous vehicle movement. Currently, I own about 110 shares of Blackberry at a cost basis of $6.78, and today's price is $7.38. And my plan for Blackberry going forward is just to hold these shares. The reason for this is because I have a larger position in Blackberry in my private portfolio that I don't want to throw any more money into this company right now. And recently, the stock price has been going up if you've been keeping track of Blackberry's charts. The reason for this is there's been rumors of a buyout from one of the largest investors in Blackberry. However, that investor, which is Prima Watson, has shot that rumor down. So we'll see what happens going forward for Blackberry, but definitely I think the stock is quite undervalued, and people are still seeing Blackberry for their smartphone failure. And one last thing to add is that they've completely transitioned out of the smartphone business as of around 2019, and they're solely focused on the security software. If you're interested in a Blackberry analysis, let me know down in the comments down below. The next stock on the list is Kinaxis. So what Kinaxis does as a business is that they provide a platform to track supply chain for companies that are involved in some sort of manufacturing business or just have physical products. And why this company has popped recently from the pandemic is because a lot of companies' supply chains got completely messed up with the whole situation. And I believe a lot more companies sign up for Kinaxis software in order to get better insights on how their business was affected if one part of the supply chain is lagging behind. So what Kinaxis' software does is basically allows people to see what happens if one part of the supply chain drops, how it will affect all the rest of the business. The traditional method of doing this is just gathering managers into a room and just having them crunch numbers on maybe an Excel spreadsheet. And this takes a lot of time. So Kinaxis' software actually saves businesses a ton of time, especially their high value employees like managers. And I've done a review on this company recently, so if you're interested in that, check out the description down below as I'll link that there. My cost basis for my shares on this company is $77.96. I currently own 5 shares, and the stock price is $170 today. So this is actually the biggest winner in my portfolio. I'm up over 118%. But at these levels, I don't plan to continue adding to Kinaxis. I actually might be selling off this position, as the recent run-up seems a little bit frothy for me, and I think that we could see a pullback in the future. So when I sell those shares, maybe I'll let you know in a future video. The next position that I want to talk about is Drone Delivery Canada. And there's been a lot of demand out there for me doing a review on this stock. This stock is essentially a penny stock, but I think they're a bit more than a pump and dump stock because I looked at the business and they actually have something to show for. What the business does is essentially they design, develop, and implement commercial drone delivery logistics programs. And they have developed 3 drones in total throughout this company's lifetime. They have the Sparrow, Robin, and Condor. The Sparrow has actually been certified to fly in the air, just like any sort of aircraft. However, the Robin and Condor have yet to be fully certified, but they're going through this process right now. And this process has been actually accelerated because of the whole pandemic situation. People are in dire need of deliveries, especially for medical care supplies in the remote areas. And these are the types of customers that Drone Delivery Canada services. One example is that Drone Delivery Canada is actually servicing some of the First Nations around the GTA area. And I think if there's any sort of news about the certification process completed for Robin and Condor, they're actually going to see a pop in their stock price. So my plan going forward for the stock is actually to just hold this position, as I currently have around 350 shares at a cost basis of 78 cents. And currently the price is at 82 cents. And this being a fairly speculative company, I'm not going to continue adding to this position because at 350 shares, if the stock price somehow appreciates to $5, that's going to be more than a 5x gain. And I can see this company going somewhere in the next 10 to 20 years. So I'll be holding this position for now. The next 2 stocks that I'm just going to briefly mention that are in my portfolio that I'm actually selling off right now is OpenText and Morneau Shepell. I currently have fairly small positions in these companies, and on OpenText, I'm up maybe roughly $7 per share. I bought it in around $50. In Morneau Chappelle, I bought it in around the $33 mark, and I'm down about maybe $1 per share. So I'll be selling these off in the next couple of weeks, so I won't really spend much time talking about these two stocks. Smash that thumbs up button if you've enjoyed this video so far, and continue watching as the next stock that I'm going to talk about is Lightspeed. And this is actually a stock that most of you voted for in my most recent poll. So I'll be doing my next stock analysis video on Lightspeed. So hit that subscribe button and the notification bell in order to stay tuned for this video. So I actually started buying into Lightspeed when they IPO'd because I like their business model. They actually create a point of sale system which allows retailers to essentially integrate their payments with their inventory and other parts of their business. So what's unique about this system compared to the traditional systems is that they actually provide a lot more data for retailers. So the traditional system that retailers use for payments today is a non-integrated point of sale system. So what this is that customers just go up to the cashier and they just insert the credit card into this machine. The cashier has to actually punch in the total value of the sale because the system doesn't know that. And it comes out onto the machine, you enter your PIN, and basically they take that receipt and have to record it somewhere in some books. However, Lightspeed's point of sale system takes all this recording and does it automatically. And on top of this, the point of sale system creates customer profiles and will give data on how customers shop in the stores. This is crucial for businesses to optimize their sales and increase their store traffic. Recently, the company reported earnings and they actually recorded a 70% increase in revenue, even with 1 month in the pandemic. So Lightspeed is growing at Lightspeed, pun intended. And the reason they were able to increase their revenues by 70% is because that their current retail customers who are in brick and mortar stores actually transitioned and bought into their e-commerce platform. And these retailers originally had not set up some sort of e-commerce platform because they didn't know they needed it. But because of the whole pandemic, this pushed companies to set up an e-commerce website and do curbside pickup or even delivery. And with this recent earnings report, the stock actually shot up by 38%. However, one of the risks going forward is that there's a lot of other competitors out there like Shopify and Square who are actually a lot larger in market cap and have a lot more cash to bully around Lightspeed. So beware if you're going to invest in this company. You definitely have to do a lot more research and dig into the leadership team and the vision of the company. Currently, I own about 45 shares and I have a cost basis of $31.07. And the share price to date is $33.36. For me, I will continue to average into the stock so that I accumulate maybe around 100 shares, as long as the prices stick around the $33 level or maybe drop a bit. And I think I'll be averaging in within the next 3 months. However, if we see the stock run up to around $40, I'll halt my buying and wait for the stock price to drop. The next company on the list is ATS Automation. And what ATS does is they are an automation company that engages with other customers to design and build automated manufacturing and assembly systems. So examples of what they build are things like what you'll see on the automotive assembly line, where they build these machines that help automate a lot of the processes, like stamping, punching holes, or even cutting parts. And examples of machines that they build in the life sciences industry include automated pipetting machines. Other industries that they service are the food industry, the medical industry, and the energy industry, to name a few. Currently, my cost basis for my shares is $18.41, and I own 25 shares. The current market price of the stock is $19.50 today. I think for me going forward, this is a fairly small position in the growth stocks that I own, and I will be looking to sell the stock if it hits $22. This is roughly in line with the levels that we saw in February. The next stock on the list is GoEasy. And what GoEasy does is they provide loans to higher risk customers. And these loans are typically personal loans in the magnitude of $500 to maybe up to $45,000, as well as they have a loan to own program for things like electronics, furniture, or just higher ticket items. And the types of customers that they service are those who are unable to get a credit card. So people who have low credit scores or have defaulted on loans before are able to go to GoEasy and obtain a loan. But the one thing to note for these customers is that their interest rates are astronomically high. They charge a 30% interest rate minimum on a lot of their loans. Yet we've seen that their business has actually grown significantly over the past 5 years. They've actually increased their share price by 178% in the past 5 years, which is phenomenal for an alternative lender. And the reason why I think they had such exponential growth is because the economy was trending upwards in general and people were willing to take on riskier debt. However, we saw a huge sell-off in the stock with this whole recent pandemic, as investors were very worried that a lot of these customers would default on their loans. My stance on this company going forward is I think they're actually going to continue to succeed. And the reason for this is, in America or in Canada, we are a society that loves to run on debt. A lot of people are living paycheck to paycheck, and a lot of these people also don't even own credit cards or are about to default on their credit cards. And when they default on their credit cards, they're not all of a sudden just going to cut their need to buy stuff. They're going to search for alternative lenders, and GoEasy is one of those. So I think going forward, GoEasy has actually executed fairly flawlessly on their plan to tackle this market, and they have a good amount of cash as provisions set aside just in case a lot of people default on their loans. Currently, my cost basis for these shares is $50.49. I own 5 shares. Today's stock price is around $56.77. I think going forward for this stock, I'll be looking to add more, as I know this is a little bit of a riskier play. However, looking at their PE ratio, it's quite low at 12.12. As well, they also pay a dividend of 2.45%. Now moving on to the third last stock that I'll talk about today, and this is Lawn Corp. And what this company does is that they own and operate funeral homes. And this business is a little bit morbid. However, there's one thing going for them is that everyone eventually will come to an end. We will all die, and therefore will likely need some funeral home services unless we do an at-home service. So Lawn Corp has a very sustainable business over time. They did see a huge drop in the stock price because of the whole pandemic, and people weren't actually able to visit these funeral homes, but they've also done other things to transform their business and adapt with the times. These are things such as providing online funeral services for their clients. And another reason why the stock actually dropped recently is because their CEO is departing. And the CEO was actually very transformative in the whole company's history. In 5 years or so, he took the company from around a $30 million market cap all the way up to close to $1 billion. So this is a huge feat for him to take on, and he's done very well. And with him leaving the leadership team, I think investors saw a lot of uncertainty going forward in whether the team will be able to continue to execute as flawlessly as before. However, after looking at the funeral home sector, I think Lawn Corp is actually in a good position to continue growing. They're actually consolidating the funeral home sector. They're buying up a lot of these mom and pop shops that have operated year over year, but maybe are running out of steam and need some sort of competitive edge. So when Lawn Corp picks up these mom and pop shops, they're able to bring them into the network of funeral homes that they have and get rid of some of the redundant management fees. Things like human resources and finances, they're able to decrease these expenses for these mom and pop shops. Currently, I own around 20 shares of this company, and my cost basis for these shares are $26.30. I do plan to continue adding to this company, as I think they have a very good outlook and a good tailwind for them, especially because we know that baby boomers, they're actually one of the largest age groups within Canada, and as they continue to age, it's inevitable that they will pass away. So I think Lawn Corp is going to capture on this trend going forward, as morbid as it sounds. And in the meantime, they also pay a dividend of 1.94%. The next stock on the list is Waste Connections. And for Waste Connections, you can kind of guess what they do. They basically are a waste collection company. So they'll go out there and collect your garbage, your recycling, and maybe even your green bins. And I think this business is a great business overall. As the consumer trends are trending towards buying more and more stuff online, we're going to see a lot more packaging in the waste. And especially with this whole pandemic, we're going to see a lot of recycling and a lot of trash. So Waste Connections is one of these businesses that rarely have any sort of pullback. And this is because the rate that we generate trash is not really dependent on whether if we're in an economic boom or economic recession. People still need to eat, people still need to buy frozen food, and people still shop a little bit. So currently my cost basis for these shares is $18.36, and I own about 5 shares. And the current stock price is $132.17. I think this is one of the stocks that I do plan to average in. However, right now I'm not really ready to average into this company specifically because there's other companies that I want to buy into. So I think for the short term I'll be holding, but for the long term I'll be looking for any sort of small pullbacks and buying into it. The last growth stock that I own is Storage Vault Canada, and this stock is actually my largest position in the portfolio. I currently own around 600 shares with a cost basis of $3.38, and currently the stock price is at $3.31. So basically the stock price is roughly around where I bought these shares for. And if we look at the 5-year chart, we can see that this stock has appreciated significantly. About 5 years ago, they were down around at the 50-cent level, and today they're trading at $3.30. So we saw about a 6x gain on this company. And you're probably asking, why is this happening? And the reason for this is because they're consolidating the storage business. And if you haven't noticed, I actually really like to buy companies that are relatively small and consolidating fragmented businesses. Companies like WELL Technologies, Lawn Corp, and now Storage Canada. And you can kind of guess from the name what they do. They actually buy up storage companies. So they buy a lot of these mom and pop storage companies where people will rent storage containers or just storage units within a building to store their stuff. And the reason why I'm bullish on this sector is because there's a lot of people moving into urban areas, and these urban apartments are very small. Like if you go to Toronto, you're buying an apartment, it's about 400 square feet to maybe 700 square feet. And if you're a retiree and you're moving into these apartments, you're going to have a lot of stuff that you need to store somewhere. And Storage Canada is going to be one of these places where you might choose to store your stuff. And I think with the whole baby boomers just moving out of their large 3 to 4 bedroom houses into either retirement homes or into condos or apartments, we're going to see an uptick in the demand for storage lockers. And for this reason, that's why I'm investing into this company. I believe that they're going to continue growing forward through acquisitions, just like WELL Technologies and Lawn Corp. And in the meantime, they also pay a dividend of 0.32%. Not much, but it still is a dividend. And I think the storage business is fairly safe to play into because a lot of people are attached to their stuff and they're not willing to throw it out. And that's the reason why they rent storage lockers. People will typically hold storage lockers for maybe 1 year up to 5 to 10 years for those people who are like retirees. And storage lockers can also see short-term business for people who are in between moves. So that concludes it for the 15 growth stocks that I currently own. Really, it's 13 after I sell off 2. If you enjoyed this video, smash that thumbs up button, leave any comments that you have down below, and hit that subscribe button and the notification bell to be notified for future videos that I release. Keep up the grind and have a great day.